Hi, my name is Nurliana and I will be talking about the background of the company. We have chosen Wells Fargo as the company that we want to discuss. Wells Fargo was founded in 1852 and the headquarters is located in San Francisco. It is a well-diversified community-based financial service company. Up to this date, Wells Fargo have approximately $1.9 trillion assets. The company had a vision to satisfy customers' financial needs and help them to succeed financially. And according to their vision, they provided services like banking, investment, and mortgage products and services. They also provide for consumer and commercial finance. They enhance their service through 7,400 locations and have more than 13,000 ATMs and through the internet, which is the wellsfargo.com, and also through mobile banking. The company owns offices in 32 countries and territories to support the customers who conduct business in the global economy. With a total of approximately 260,000 team members, they serve 1 in 3 households in the United States. And recently, they was ranked at number 29 on Fortune's 2019 ranking of America's largest corporations. Now, moving on to the nature of the scandal. The scandal started in September 2016, which is the fake account scandal. It all started when Wells Fargo's public woes kicked off with 185 million in fines. All of the fines are from Consumer Financial Protection Bureau, the Office of the Comptroller of the Currency, and the City and County of Los Angeles. This is due to the creation of 1.5 million fake deposit accounts and more than 500,000 fake credit cards, all in the customers' names, and they had to use it without their permission and consent. A total of 5,300 low-level employees were fired for creating this account under extreme sales pressure. This kind of sales pressure leads to similar issues at large banks, whereby an academic research had been shown. The aftermath of this scandal is the then CEO John Stumpf was fired and had 41,000 million in compensation clawed back. Later that month, Wells Fargo said that it would stop unreasonable sales goals. In a class action suit, Wells Fargo agreed to pay 142 million to the affected parties, which includes millions of customers involved.
My name is Ashmal. I'm going to present about creative accounting. What is creative accounting? Creative accounting consists of accounting practices that follow required law and regulation but deviate from those standards intended to accomplish. Creative accounting capitalizes on loopholes in the accounting standard to falsify, portray a better image of a company. Although creative accounting is illegal, but if overdo it could lead to fraud action. There is two reasons why the firm use creative accounting. First, to prevent the shareholder from withdrawing their capital, and second, to show good stewardship. What method of fraud that Wells Fargo use? First, the employee create a fake account and a fake credit card. This amount could show that the company have a very good sales and can impress the shareholder and other stakeholders. Wells Fargo employee had all the access to all customer account. This could lead to a misappropriation of asset of the employee. The employee can use the information from the customer account and create the credit card for them even though they not request for it. Why this fraud happened? First, overbearing sales culture. The management of the company usually set a very high amount of sales target to be achieved by the employee each term. So, with this pressure, the employee feel pressure and desperate to do anything to fulfill their target, and there are wills to do any fraud or any unethical action.
Assalamualaikum. I am Aida Hanani, and I will talk about efficient market hypothesis and agency cost of dispute. Efficient market hypothesis is an investment theory whereby share prices reflects all information available and responds only to unexpected news. Prices can be regarded as optimal estimates of true investment value at all times. According to EMH, stocks always trade at their fair value on exchanges, making it impossible for investors to purchase undervalued stocks or sell stocks for inflated prices. It is impossible for investors to predict whether the price will move up or down, as future price movements are likely to follow a random walk. Therefore, it should be impossible to outperform the overall market through expert stock selection or market timing. An average investor is unlikely to beat the market, and the only way to obtain higher returns is by purchasing riskier investments. EMH is useful in judging the relative efficiency of one market compared with another. The fake account scandal at Wells Fargo has done real damage to the bank's stock price. Wells Fargo stock is underperforming Tuesday pre-market as Sloan, the president and chief executive officer of Wells Fargo, prepares to appear before a House committee focused on what it is calling a pattern of consumer abuses. Wells Fargo stock sinks to 2.5-year low. Stock closed below $45 on Monday for the first time since February 2014, and it is now down 10% since Wells Fargo was slapped with a $185 million fine for creating as many as 2 million fake bank and credit card accounts. So the graph represents the fall of share price. The 31-month low for Wells Fargo stock is likely to push more people to call on the company to replace longtime CEO John Stump. Therefore, this case can be categorized as strong from EMH, which means all information is priced into stocks and no investor can gain advantage over the market as a whole. Next, about agency cost of disputes. Agency cost usually refers to the conflicts between shareholders and their company's managers. A shareholder wants the manager to make decisions which will increase the share value. However, managers would prefer to expand the business and increase their salaries, which may not necessarily increase share value. So share price of Wells Fargo dropped drastically due to unreasonable sales goals. Therefore, shareholders of Wells Fargo incurred loss due to reduction of share price. Wells Fargo was subject to pay $185 million penalties and $5 million to customers that regulators say were pushed into fee-generating accounts that they never requested. Moreover, the Consumer Financial Protection Bureau will receive $100 million of the total penalties, which is the largest fine ever levied by the agency, which was conceived after the 2008 financial crisis. Due to extreme sales pressure, 5,300 Wells Fargo employees were fired over a 5-year period for creating fake deposit accounts, and the CEO, John Stump, was fired and had $41 million in compensation clawed back.